Thanks so much for joining us here on the Market Day Report. I'm Marlon Bowling with you. We're watching your ag commodity trade on a very active Monday here in the grain markets. And I want to go to the phones and actually bring in some expert help along the way and help analyze these markets. Let's go to the phones and welcome Brian Splitt of Allendale Incorporated. And of course, he's based in McHenry, Illinois. Brian, thank you for joining us here today as we look at our market action. Just got this new information in from USDA. It's our export inspections numbers. It looks like on the corn, we dropped down to 1.09 million tons from 1.46 million last week. Sorghum, 115,000. That was a vast improvement over last week, but it's still under what we had a year ago. Soybeans, 521,218. That was under the week that we had before. That was 646,000. A year ago, though, just for a point of reference, that was 194,000. And on the wheat, 574,588. The week previous, we had 632,000, and we also had a year ago 355,000. So an improvement from a year ago on the wheat, even though it backed off from the previous week. All right, so with that being said, a lot of action going on in the futures trade here today. Brian, wanted to get your take on what you're focusing on here.
Well, I think the major news is the weather developments over the weekend, and it was well forecasted, but, you know, some are always skeptical to see if the weather events will come to fruition, and this definitely did not disappoint with some of the snow totals that we saw in hard red wheat growing regions and the rain totals that we're seeing as producers are wanting to be in the field and getting corn and soybeans in the ground.
Brian, last Friday we talked about the fact that the May contracts on the grains had gone into delivery mode, and there seemed to be fairly heavy deliveries of corn and soybeans. What's the case today?
Well, you know, you're going to have the initial deliveries after first notice day, and, you know, that might show the early sentiment on those contracts. But when you have developments like this with weather over the weekend, and especially seeing how short the managed money is in the market right now, they are record short, you know, in aggregate across the three major agriculture commodities, corn, soybeans, and wheat. And when you have that set up with a weather event happening over the weekend, that is just begging for aggressive short covering, which is what we're seeing today.
All right, soybeans have July now trading 15 3/4 higher on the board here. We're trading at 9.72 per bushel. August up 14 3/4. Your new crop November now 13 1/4 higher at 9.66 1/2. So we're a couple of pennies away from our recent high of the day today. Let's back up and catch the corn prices here. On the July corn, we're now trading a dime higher at 3.76 1/2, within 2 ticks of our high of the day. And now you have your December contract at 3.93 3/4. That is up 8 3/4 cents. On the wheat trade in Chicago, we have July currently trading 20 1/4 higher. Last trade 4.52 1/2. Kansas City on July. We are now trading that KC wheat market at 4.62 1/4. That is just 1 tick off its high of the day. And look at this. Now we're 25 higher. And on the Minneapolis wheat trade, we have July currently trading 9 1/4 higher at 5.64. Brian, back on the Kansas City wheat market there, I know they had been doing some adjusting a while back. Do you recall off the top of your head what the limits are on Kansas City wheat these days?
Oh, shoot, I believe the limit today was going to be 67 1/4, should be 30 cents.
Okay. All right. So we'll keep our eye on that. They're getting up there into pretty lofty levels today, of course, with all the weather that occurred last weekend. Brian, can you stick around here for a minute and talk a little livestock with us?
Yeah, absolutely.
All right. We'll do that. We'll pause for a break, and our guest, Brian Splitt, will be back with us. We'll talk about the cattle and hog markets right after this. Back with you here on the Market Day Report, and we are talking with Brian Splitt of Allendale Incorporated, and he's based in McHenry, Illinois. I want to talk with Brian about our livestock trade. Livestock markets have been a wild affair, especially in that cattle complex for the last week or more. And Brian, last week we had some cash cattle trade that developed all the way up to 137. I think I heard some rumblings of 138 on a live basis last week. And then the April futures went off the board, first on the feeders on Thursday, then on the live cattle on Friday. So that meant we rolled over into the next month. And when they did that, there was a big disparity between the nearby contracts that expired and the June that's taking over. So let's take a look at where we are now in that June contract. Keep in mind the last cash cattle trades that we had were in the mid to upper 130s. Well, now your lead futures trade has June at 124.28, and that's 26 higher. August up 13 at 120.18. We've been on both sides of unchanged here today. Looks like the nearbys are just a touch firmer right now. The deferred's a little weaker. Now, on the feeder cattle side, you currently have that May contract down 37, August down 45 at 154.25, but it's been a fairly wide range already of almost $3.50 so far today. So the activity continues here in the cattle complex, but back on that live cattle board, the disparity between the nearby June now, which is our lead month, and where we are in the cash trade has something has to give here sooner or later, you would think.
So, right. And last week on the Fed Cattle Exchange, which is the electronic platform, they did trade cash at 125 for delivery that would have been 17 to 30 days out. So now based off of this June contract. So far, June has made it up to 125.32.5 today, pricing in that cash trade. So we'll see what cash trade develops this week. And I would expect that if the cash market continues to push above 125, that the futures are going to want to meet the market.
So what do you think we have? Maybe 45 days, 50 days to try and get those two together, the cash and the June?
It's hard to say. We did see April maintain, a $10 discount to cash for quite a while, and that was a lot of the discussion: is the cash going to come down, or are the futures going to go up? And the cash then continue to go up from there. So, the cash market is king right now, but you have to be very careful with the cattle market. A market like this has an open interest of, let's say, 180,000 contracts in June. Well, compare that to 750,000-ish in the July corn, and the size of the fund position is almost the same, not quite. So I guess what I'm getting at is if we get to a point where the story changes and the funds need to get out of their long cattle positions, that market cannot handle the same type of volume that corn can. And so if you're a producer and this market's seen these gains the way it has, it's probably not a bad idea to have some puts under the market, as seasonally we're going to be moving into a time frame when the weights should start to increase. And, that's been part of the bull story, is weights have been below the last several years, but seasonally we should start to see weights bottoming out. So the next, 30 to 45 days, I think, is a good time frame for this market to try and put in some kind of a high and return to maybe a downward trend from there.
Well, thanks for pointing that out. A quick look at our lean hog trade, and Brian, then I'll let you go. On the lean hogs, we currently have the May contract down 38, June down 72, with a last trade of 73.28. That's a little over $1 off our high of the day. The July at 74.82 is down 40. Brian, thanks so much. Appreciate it. Good to visit with you. Brian Splitt of Allendale Incorporated in McHenry, Illinois. So there's the latest choppy market so far, trying to find its way on the cattle.
Okay, we'll keep watching it. Thank you, Markets Editor Marlon Boland.